what we've seen in Q2 was that gold demand overall was relatively flat year on year. But overall of H1, we're down 10% compared to H1 2020. And the reasons for that really were that while we saw strong consumer demand recovery in strong consumer demand and inflows into gold ETFs in Q2, they were really insufficient to offset what were heavy outflows in ETFs in Q1. So if we look at the main sectors of demand, we have investments. As I said, in Q2, we saw inflows of about 41 tons. But overall, in H1, we saw outflows of about 130 tons. On the jewelry side, we saw an increase of 60% year on year in Q2. Again, that was off a very low base in Q2 2020, where the pandemic really dented jewelry demand. But some of that was also due to the economic improvement we've seen in the most recent quarter. And then finally, on the central banking side, we saw 200 tons of net purchases in Q2, taking the H1 total to 333 tons, which is a rather significant number. And again, we saw large purchases from countries such as Thailand, Hungary, and Brazil. So overall, we're seeing the diverse sectors of demand respond quite well to the kind of evolving economic environment. In the first quarter in particular, we saw gold really being driven by movements in interest rates in particular. So as we saw that treasury yields or sovereign debt yields increased, that really dampened kind of the interest in gold, because it changed the opportunity cost kind of equation when it comes to holding gold. However, as we moved through the first half, we actually saw that the inflation story kind of took hold, and that really was a significant driver. And as I'm sure your viewers will know, kind of concerns around the economic growth direction, the direction of inflation, and kind of what that may mean for interest rates has been a dominant story for the year as a whole so far. So I think that's been one of the key reasons why we've seen these divergent flows into gold at a kind of institutional investment level. So where rates were having a major impact in dampening that demand in Q1, when the inflation story took over in Q2, that really helped boost inflows into gold that we saw predominantly through gold ETFs, but also in bars and coins too. What's worth looking at in 2021 is really the recovery from the impact of COVID last year. So as I said, Q2 for mining in particular was the weakest quarter, where the COVID pandemic had the biggest impact in Q2 2020. So what we've seen is a really speedy recovery from that. In fact, if you look at H1 2021 as a whole, I believe in the report we say that it was the highest on record, if my memory is correct. So it really has shown that resilience in the gold mining industry, that while yes, some certain mines had to close, jurisdictions had to go into lockdown because of the pandemic, and that obviously impacted the amount of production we saw last year. That really has kind of turned around this year, and we're seeing a much more normalized picture. Now, going forward, I think it certainly looks like the pandemic will have a limited impact going forward. Obviously, that is on the provision that we see no more variants or waves in certain areas, which is always a risk. But certainly the mining industry certainly seems to be operating much more normally than it was compared to last year. Now, if we look at supply, we must also consider recycling. So we saw rather muted recycling in the second quarter. And again, some of that is down to the improving economic picture, but also some of it is just down to a modest increase or difference in the gold price between Q1 and Q2. So overall, I think supply looks relatively robust for gold, which I think stands the market in very good stead.